Continuing with our earnings interaction, we are joining with Ajit Kumar, the chairman of Suprajit Group. Now, the company reported a strong set of numbers. On a sequential basis, we did see some margin expansion. So, firstly, my question to you would be, sir, this expansion on margin, is it completely because of the lower raw material prices? And is there some more room for expansion going forward, or that's for FY24?
Good afternoon, and thank you for having me on your channel. Yes, last year has been a very good year for us, both in terms of growth and margin expansion. The last quarter's margin expansion has to be seen from the overall year's performance. I think we have consolidated and improved our margins by almost 100 basis points. Now, yes, there has been some help from the commodity prices having softened a little bit. But I think more so due to the integration and the consolidation of our business and operational improvements. I think they have been largely responsible for some improvements in certain, within certain group divisions, and that has helped in overall margin improvement.
Right, we have seen the margin improvement in the last year, but I understand that for FY24, the outlook is a bit weak given the fact there is a bit of transition happening. The traditional ICE two-wheeler business is seeing a bit of a weak market, and the EV penetration is also impacting the overall market dynamics. How do you see FY24 panning out for your company?
And we just have, given our press release where we have very clearly said that we see a strong year, that the outlook for the current year is promising. You are right. I think the penetration of EV is a important factor. There is some amount of tempering or muted growth in the two-wheeler business, particularly in the entry segments. The rural market seems to be still not out of the woods, it appears. And also at the same time, the EV evolution is also having some amount of concern with consumers whether to buy or not buy a ICE engine, the vehicles. So having said all this, what is happening with us is that we are in conversation with all the EV players, at least the top 5 or 10 of them, and we are in the process of getting additional businesses, particularly for our Suprajit Electronics division. STCs were doing some wonderful new project development in the EV customers, and I think this will help us in ensuring that although there is some turbulence in the two-wheeler market, our business will be completely unaffected as we see for the current and the next couple of years.
When you say you're expecting a strong growth in the coming year, help us quantify that. 15 to 20%, 20 to 30%, how would you define a strong year?
I think we always said how we will perform vis-a-vis the market. I think as I see it, the markets will grow not more than a single digit in this year because the two-wheelers market will continue to struggle. Although passenger vehicles have been strong last year, so hence you can't expect the same strength this year. So overall, it will be some kind of a single-digit growth. All we have said in all our outlooks is that we will outperform the Indian automotive industry by 5 to 10% on a consolidated basis. I think we'll still stand by those guidelines that we have given.
So your global revenue share has increased from 39% in FY22 to 53% in FY23. How much further can this number increase? Because we believe that the margins on the export business would also be much better.
Yes, I think we have crossed the magic 50% of our business being outside of India now. That's largely because of the new acquisition that we have done last year, the LDC from Kongsberg. That's why the graph is now flipped more outside of India. In terms of margins, there are select pockets within this global business that we do very good, very well. In select non-automotive businesses, particularly that has been done out of India, we have a very good margin. Similarly, in the automotive business, the business that is done between Suprajit Automotive and Suprajit Europe is a very strong margin business. At the same time, the LDC part of the business is somewhat weak. As you know, we just acquired it last year. Although the business growth is expected, in fact, the LDC is expected to touch $100 million this year, the margins will take another year to consolidate and grow. So that will be slightly lower margin business compared to the other business. So overall, I think the what we call as the Suprajit Controls division, which comprises of all these businesses, will do a strong double-digit growth in the business growth, and the margins will further improve from the last year's level.
saying Suprajit Control division is likely to grow in double digit in the coming year as well. But I understand you also have a capex plan of around 1400 crores lined up. Could you talk to us about what's the capacity expansion? Which verticals are you seeing the maximum traction at the moment?
I think the capex that has been planned for the next 12 to 15, 12 to say 18 months is about 140 crores. And most of it is, kind of strengthening our operational requirements within the group across all the companies. There are a couple of new projects we are looking at, one in Pune and one in Bangalore. And beyond that, it's all requirement of capex for equipments and IT services, some automation projects. Because another thing that we are doing is continuing our journey in the automation zone, so that the operational expenses and costs come down. So all of them will be about 140 crores for the next 18 months. It is spread across all our divisions, and they're quite optimally managed.
Sir, the non-auto division of yours, now that surprises Street, and that was a good set of numbers. Street was expecting weakness in the fourth quarter when it comes to the non-auto division. So what led to this outperformance firstly, and secondly, what is the outlook when it comes to this non-auto division? Will it yet again continue to outperform in FY24 as well, or is there some slowdown that we are seeing right now?
Particularly in the North American market, I think the non-automotive side of the North American market is, I would say, muted, little weak, I would say. The recessionary trends are there to be seen. So first thing that the consumer does is not to buy a tractor or a, lawnmower or a power sport vehicle, because they're all probably can wait. So this is what is affecting the North American non-automotive business. So that said, that will have some impact on our business growth. So this year, we expect the growth to be really muted in the non-automotive segment. Having said that, the overall business will grow, but the non-automotive part of it may not grow as well. And last year's margin, coming back to the point that you raised, the overall margin in the non-automotive Sena business has been about 14%. That has remained more or less stable compared to last year. Only in the Q4, we had certain one-off effects, so it shows a skewed extra margin. But overall margin has been stable compared to last year, and slightly better. That's about it.
Will remain stable going forward as well, the 14% margin for the non-auto segment as you talked about?
Yeah, I think generally those margins have stabilized now. The only place that we need to do some work is probably LDC. Other divisions have a fairly stable growth and margin profile now.
Okay, on that note, sir, we let you go. Appreciate you joining us on the show.